We got Gary Dorsch on the line, the editor of the Global Money Trends newsletter. Gary, this is Saul Albom, Market News First. How you doing?
Hey, Saul. Glad to be with you here today.
All right, and I'm, excuse me, I'm glad also. Now, Gary, we've been expecting some balance sheet bombshells. We've been expecting that these investment banks would get hit hard due to a mark-to-market basis on their subprime, on their debt that they have to hold from the private equity. Also, we're having to deal with lowering of a 50-point drop from Bernanke, a 50 basis point drop from Bernanke. What do you see in all this? For one, Lehman Brothers and MS, are they, Morgan Stanley, was that, from what you've seen, is that what you were expecting? Is it better than expected? And this half-a-point drop pumping in dollars, is this going to exacerbate problems in the future? What are you seeing, Gary?
Well, I haven't really looked at the details very closely on Lehman or Morgan Stanley, although looking at the headlines and glancing through some of the paragraphs, apparently they are reporting lower losses on their mortgage portfolio than had been expected. It's also possible they may have had a lot of these positions hedged off through certain derivative positions. But we did see a bank in England almost went under completely over the weekend. Northern Rock, which is the fifth largest mortgage lender in England, and it's a pretty large bank. It has about $180 billion of customer assets. So Bank of England and the UK Treasury were forced to come out with an extraordinary statement guaranteeing the deposits of Northern Rock depositors to fend off a major run on a bank and possibly creating greater hysteria in the banking industry in England. Today, the Bank of England was forced to reverse itself from its hardline stance of refusing to inject liquidity into the London money markets. Today it did reverse itself and said it would inject $20 billion worth of British pounds, or about 10 billion pounds into the London market. So, how this all is fending out, lo and behold, the Dow Jones is now within 1% of its all-time high. So there's been millions and millions and millions of words written about this subprime mortgage crisis, about the massive losses that'll be taken by banks and brokers around the world. And lo and behold, by simply printing hundreds of billions of dollars, as the Federal Reserve has done in the past few weeks, it makes everything all better. It's the elixir that cures all ills, is simply to inject lots of money. And the Bernanke Fed has injected about $290 billion into the U.S. banking system in the last month. That's more than the Greenspan Fed pumped in after the September 11th terror attack. So it's an extraordinary amount of money, and the money supply in the United States now reported to be 14% higher from a year ago, as measured by the M3 money supply. And I think it can possibly go to 18% money growth in the United States, which would be unprecedented, and I think could ignite hyperinflation later this year.
Wow. Those are pretty strong words. And how could the 18% increase ignite hyperinflation? And are you seeing any signs of inflation right now?
Well, I guess with crude oil trading over $82 a barrel, nobody seems to be complaining about that. That's a pretty high price. I remember a couple of years ago that if oil ever came close to $40 a barrel, it would send alarm bells about a global recession going throughout the world and would trigger big sell-offs in the global stock markets. But today it's a very comfortable price of 82. If you look at oil discounted for inflation, it's actually lower than it was in 1979. It's about a $90 a barrel would be an inflation-adjusted price if we were to value oil in that sense. So it's possible we could see oil hit $90 a barrel and not have anyone complain about it in the stock market, but it is very inflationary. Also, if anyone's been watching food prices on the agricultural front, we've seen soybeans have gone up 50% in value in the past 5 or 6 weeks to near record highs of $9.75 a bushel. The price of wheat has doubled in price over the past few months. The price of milk in the futures market is up 70% from a year ago. Of course, we all saw gold go over $700 an ounce this week, now at close to $725 an ounce. That's a 28-year high. And so, and we've talked about the Baltic Dry Freight Index, which measures the cost of shipping dry goods around the world. That's tripled in value and tripled in price from a year and a half ago. So the cost of shipping these goods is tripled. So there is a lot of inflationary signs out there. Plus rapid money supply growth, which currently at 14% and maybe on its way to 16, 18%, all points to higher inflation. And I've been mentioning this to your listeners now for several weeks, and that we have seen dramatic increases in all these commodities. We've also talked about the U.S. dollar at a 15-year low, and that's also inflationary. So all the signs are there for anybody that wants to acknowledge them.
Well, there you have it. Right now, we have displayed Gary, where we did have displayed, Gary, the might be a little difficult to see. I'm not sure if they can pull this out. We're working on some new technology where you can see the screen, see my screen. We have a comparison of the yen carry trade. How do you think that this would get complicated on top of the yen carry trade?
Well, the yen carry trade was responsible for a lot of the increase in the stock markets from March up and through July. It was all based on a lot of cheap money borrowed out of Japan, and that trade unwound violently from mid-July through mid-August. And it looks like the yen carry traders are not a big part of this current rally, this big recovery rally. The dollar, which had fallen from 124 yen down to 112 yen, has rebounded to 116 yen, but is still way off its previous highs of 124 yen. So there has been some yen carry traders coming back into the market, with the dollar recovering from 112 to 116, but it's not as big a factor as it was earlier. I think the big factor now is the enormous amount of money being printed by the Bernanke Fed, which is inflating asset values. So people have to decide how they're going to protect themselves from higher inflation, and I'm sure they're all familiar with it when they go to the grocery store every day.
Well, Gary, we'll have to leave it at that. We'll have to have you back tomorrow. Gary Dorsch, the editor of the Global Money Trends newsletter. You can get his newsletter. And don't forget, we're bringing up the symptoms. If you want the cure, you'll have to check out his full-page service at Sir Charts a Lot. Subscribe to his newsletter. Gary, thank you so much for joining us today. Are you going to join us tomorrow?
I am publishing my top 16 stock picks for the fourth quarter. That'll be in Friday's edition at globalmoneytrends.com if you want to sign up there. It'll be available on Friday's edition, and then we'll see you tomorrow, Saul.
All right. Gary Dorsch, editor, Global Money Trends. Thank you so much, Gary. We got more market news coming up next. Recap, microcap markets. Then we're going to get right into the specifics in the microcap engine. Saul Albom, market news, first news you can trust. Don't touch that mouse. We'll be right back.